And first order of business here, I'd like to take a moment of silence and remember those that have fallen since the last time that we met. Okay, thank you. All right, we need action to approve minutes of both the meeting of the 25th and the 16th. We'll begin with the approval of the September 25th meeting minutes. It's been moved and seconded. Are there any comments, questions, or corrections? Seeing none, all those in favor of adopting the September 25th minutes, please signify by saying, please vote. Okay, so you're an aye. Paul and I. That's all right. We'll get it fixed. Okay. Mark, you're in favor? Okay. The record will reflect the vote as documented here, so the motion carries. Now, the approval of the October 16th meeting minutes. Is there a motion? Moved and seconded to adopt, or to, approve the October 16th meeting minutes. Are there any comments, corrections, additions? Seeing none, all those in favor of adopting or approving the October 16th minutes, please vote. Okay, the motion carries. All right, I'll turn the microphone over to Steve Nelson, the director, for the introduction of our first presentation.
As you'll recall, earlier this interim, the board asked the Office of the State Actuary if they would be willing to do 2 educational briefings this interim. The first one was on different funding methods, and the second one is on the asset smoothing method. And we've got Lisa and Aaron with us again today to do that presentation. The asset smoothing method that's currently used is in statute, and that statute predates the board. So this is something that the board has never adopted, which is one of the reasons why last interim this was something that you'd asked to have a briefing on. With that, I'll turn it over to Lisa and Aaron. Thank you.
Thank you, Director Nelson, and thank you, Mr. Chair and members of the committee. For the record, Aaron Gutierrez from the Office of the State Actuary, and sitting next to me is Lisa Wan, also from our office, one of our actuaries. As the director just mentioned, we 2 months ago had given an educational presentation on the actuarial funding methods. Quick recap of that, there are different funding methods with different pros and cons. The current LEOFF funding method is using parts of 2 different funding methods, the aggregate funding method and the entry age normal funding method. Now that combination of funding methods does not allow for an unfunded actuarial accrued liability, and it manages the contribution rate volatility in 2 different ways. First off, by having a rate floor, and second, by having an asset smoothing method in place. And so that's a perfect transition into today's presentation. I'll start off with talking about some of the theoretical things about what is an asset smoothing method, why you might want one, and what are some of the considerations for choosing a method. Then I'll be handing it over to Lisa to talk about how that method works in Washington and some comparison of some different funding, comparison of different asset smoothing method options. So beginning with what is a smoothing method, at its core, we're talking about a way to manage the short-term volatility in the investment market and a way to provide more stable contribution rates. Essentially what's happening is anytime the actual rate of return is a certain threshold, above or below a certain threshold around the expected rate of return, then a portion of that return is going to be spread out over a longer time horizon. There's lots of different ways that you could structure your smoothing method. There's a lot of different professional opinions on this about which measures should be smoothed, what length of time this should be done over. Should it be over years? Should it be over decades? And there's a lot of disagreement on whether or not smoothing should take place at all. For the most part, as a practical matter, we're typically referring to a set portion of returns being amortized over less than a decade. A very basic graphical example of how smoothing can work. What we did, wanted to take something that was outside of the plan, just a very generic example. So what we've got here is the S&P 500 returns from going back to 1980. And as you can see, fairly smooth at the beginning. The lighter blue line, I think they're both blue, but maybe that's blue and black. The blue line is fairly smooth up to about the mid-90s, then goes up a much more sharp angle. Then, of course, you can see at some point it enters that sort of sawtooth pattern. So to show how a smoothing method could work, we took those returns and applied a fixed 8-year smoothing method to them. And you can see that black line, or the really dark blue line, is a much more smooth line moving up towards the same basic direction. So what are the considerations when choosing a funding method? First of all, just like we talked about with the funding method presentation, the asset smoothing method is really just one big piece of your overall funding method. And so you want to make sure that all these pieces are going to be working together in harmony. Constancy is also important, a long-term choice. That doesn't mean that you can't make adjustments to the smoothing method, just that if you make too many adjustments, if you do it too often, there's a danger that it could be used to shop for the results that are favorable to your conditions or to the plan conditions. Also, it's important to consult with your plan actuary. First off, the board is required under state law, and also I believe it was under the initial initiative, to consult with an actuary. It doesn't necessarily have to be our office, but the board is required to consult with an actuary. And so that actuary is going to need to comment on the reasonability of the decisions and the funding methods and the results. And the actuaries are going to be guided by these things called the Actuarial Standards of Practice, or ASOPs. Now, these are not black and white rules, but they do set guidance for actuaries. So some of the things that they'll be expected to comment on, first off, the consistent treatment of actuarial gains and losses. It's important not to for example, recognize all the gains immediately and defer all of the losses over time. It's expected that both the gains and losses will be treated equally. Also, the assets will need to fall within a reasonable range, what we typically call a corridor. So if you take your whatever your market value is, at some point there's typically going to be like a floor and a ceiling above and below that the actuarial value cannot exceed. I mentioned earlier that you have a choice of how long you want to defer any impacts, but the actuaries are going to be expected to comment on whether or not that choice of time is a reasonable one. Whether it's 3 years, 10 years, whatever, the actuaries will be expected to comment on that. To what degree would you want to smooth the assets? Again, there's lots of different combinations, lots of different options available. Again, you can take many different lengths of time. The typical range we see for this sort of thing is between 3 to 10 years. The corridor I mentioned earlier, we typically see a corridor of somewhere between plus or minus 20 to 30%. So based on your market value, anywhere from the actuarial value could be anywhere from about 80% of the market value up to 120% of the market value, or 70 to 130, somewhere in that range. You also have an option of either fixed or dynamic smoothing method. Now, in a fixed method, it's fairly straightforward. All the gains and losses would be smoothed over a fixed percentage of time. Typically, what we see for something like that is somewhere around 5 years. but it's also possible to do a dynamic smoothing method similar to what the board has in place right now. In other words, the bigger the impact, the longer it takes for you to absorb that impact. With that, I'd like to hand off to Lisa to talk about Washington. Oh, sure.
Actually, I'm going to get into that in just a moment, if you don't mind. Perfect. It was perfect. Thank you. So, yes. Sure. Why don't I start with that, and then we'll move into the other question about the funding, the smoothing method for LEOFF 2. So that was the first slide that Aaron introduced, which was a recap from the first educational piece, and the there's different funding methods available, and the aggregate funding method, which is the core or base funding method for LEOFF 2, does not allow for an unfunded actuarial accrued liability. It basically, the funding method just doesn't have that in it. And that's one of the benefits of the program that LEOFF 2 has adopted. Any more questions on that one?
How does that policy?
So what that means is whenever there's gains and losses, they get immediately recognized, except for this smoothing method. They get immediately recognized and built into the contributions and paid for over the salary of the current members.
Okay, thanks.
You're welcome. So moving back to the smoothing method, in Washington State, the smoothing depends on the size of the change in that gain or loss. So as Aaron mentioned, there's a fixed smoothing method option or dynamic, and for Washington State, the dynamic method has been adopted. And what that means is the larger the gain or loss in a year, the longer you smooth that. More time to defer it and recognize it. Washington also has those boundaries that Aaron talked about, the corridor, and it is a 30% corridor for Washington. So the actuarial value cannot fall below 70% of the market value in any valuation, any snapshot in time, and it cannot exceed 130%. And we'll see that corridor a little bit later in this presentation with a graph. We've also included in there the actual wording from the RCW that explains how this asset smoothing method works for Washington. So we've also provided here the schedule of asset smoothing for LEOFF 2, and this table is in your actuarial valuation report. And I'll just try to explain a little bit of how this works. If you look at the highlighted row right in the middle, if your actual return in a given year that we're doing the valuation falls within 1% on either side of your expected return being 7.5%, then the assets, the actuarial gain or loss is smoothed over 1 year. In other words, it's recognized immediately. So if it's a small gain or loss within 1%, we're going to recognize it immediately in your actuarial value of assets. Then if you look at the row above that, if your actual return is within 1 to 2% of your expected, so 8.5 to 9.5, then we're going to smooth that over 2 years, basically divide that total gain loss by 2. And half of it will be recognized immediately, the rest will be recognized the next year. And then as you continue going outside, you can see every 1% increment, we're going to defer it an extra year, smooth it over an extra year. And by applying this smoothing method to the investment gains and losses, it produces this actuarial value of assets. And that's what we use for determining your funded status and also calculating contribution rates. So the smoothing becomes your new asset value that's used for your funded status and your contribution rates, and that's how we get some additional stability in those contribution rates. So we start with the market value of assets. We subtract the total deferred asset gains and losses to come up with your actuarial value of assets. Those total deferred gains and losses are your prior deferrals that have been rolled forward a year plus that year's deferred amount. And we'll go through an actual calculation because that's fun. And then when we get to that actual value of assets, then we also apply that corridor. So we make sure it's within 70 to 130% of that market value. And that gets back to that actuarial standard of practice that Aaron talked about, that your actuarial value needs to have a reasonable, or should have a reasonable relationship to the market value. And that's how we determine that. So here's another chart that comes right out of your valuation report. And this is the development of the actuarial value of assets. And if you will just kind of look at the big numbers, because we're going to break this down a little bit, this chart for you. So again, we start with the market value up there at the top, $6.6 billion. Then we subtract the total deferred asset gains and losses, so the rolled forward from the previous year plus adding on that current year, the 2012 amount. And that gets us to the starting point actuarial value of assets. Then we look at that corridor, the 70, 130%. Does that number fall within it? Yes. Okay, that's our new number. So we end up with an actuarial value of assets at this point in time, the June 30th, 2012 valuation of $7.2 billion, because we're still deferring at this point almost $600 million. Yes.
Lisa, is the 70-30 a more liberal corridor than the 80-20 would be, as far as?
It is, but it also is consistent with a little bit longer deferral period. So we tend to see a 20% corridor more with a 5-year smoothing, and then a little bit longer corridor with a longer smoothing period. So I also thought I'd give you the math behind that deferral calculation in case you're interested, and you could actually work this all through yourself and see how it works. So bear with me, and we'll take a look at what I've got here are 3 fiscal year numbers that correspond to numbers that were in that chart we just looked at. So in 2010, the 2010 valuation, the actual return that year for LEOFF Plan 2 was almost a 13% return. At that point, the expected return was 8%. So we almost had almost 5% gain on assets that year from expected, which translated to a 5-year deferral, 5-year smoothing. The actual gain was $219 million. When you smooth that over 5 years, it means you're going to recognize annually about $44 million with rounding. So we recognized 1 year of it in 2010, 1 year in 2011, 1 year in the 2012, the current valuation. So at that point in time, we've recognized 3 years now. That means we still have 2 years remaining, which means we're deferring, with rounding, $87 million at that point, at the June 30th 2012 valuation. Okay? So same thing if you look at 2011, that gain was more than 8% from your expected, so the maximum is an 8-year smoothing. And then in 2012, we actually had a loss on the assets, and in this case, it was between 6 and 7%, so it was a 7-year smoothing, and there's all the numbers related to that year. So in the 2012 valuation, we're going to recognize 1 year of that 2012 loss. And then you can see how those numbers flow right through this table that I showed you in a prior slide. So I've highlighted the 2010, 11, 12 that we just talked about. So that gets, every year that happens, we roll forward what we've been deferring, we add in that current year's results, and that gives us our total amount we're deferring at the valuation date. So we also wanted to show you an example of the market value versus actuarial value, similar to what Aaron showed earlier, but this is actually LEOFF 2's results. So you can see that in the middle of those lines that we've got a lot of blue colors on there. The middle blue line that's got the more volatility is your market value of assets. You can see the corresponding lines up and above and below, which is the corridor. Okay, so your actuarial value will always have to fall within that corridor. And then you can see that very smooth line, which represents your actuarial value. And you can see that when your assets are used to calculate your contribution rates, when you've got that volatility, that up and down, that's going to translate to your contribution rates. So the smoothing method provides that more smoother transition of your assets through that period of time, which results in more smooth contribution rates. And out in the later years, they converge because that's where we are expecting the 7.5% return those years. And they converge at the time that we've now recognized all past deferred amounts. And now we're getting an expected 7.5% return in those later years.
Lisa, could you go back one slide?
Sure.
So looking at this slide, that's the current amounts from the most recent valuation.
Correct.
So if there's still $1 billion in deferred losses from 2008 and 2009 yet to be recognized in LEOFF Plan 2.
Correct.
And that's why overall we still have $581 million in losses yet to be recognized.
Correct.
Okay. All right.
Got that all right. And one last thing just to point out on this this graph, you can see that in 2009 when we did have that large asset loss, the market value came way down. We didn't recognize all that loss in 1 year because of the smoothing method and the deferral. The actuarial value of assets for LEOFF Plan 2 almost hit the corridor. I think it was 1%. I think it was 129% of the market value, so almost hit that corridor. So now we just want to take a few minutes and look at a couple of hypothetical smoothing methods in relation to what LEOFF Plan 2 has in place right now. So first, we're going to look at no asset smoothing. So all the gains and losses are recognized immediately. There's no deferral of any gains and losses. We're also going to look at a 5-year fixed smoothing where every actuarial gain and loss every year, no matter how large or small it is deferred is smoothed over a 5-year period, and a 20% corridor in place. So that 80 to 120% market value corridor. And then comparing to LEOFF Plan 2 again, which is the 8-year graded smoothing. So this chart shows, and these are estimated, we have to make a lot of assumptions when we're going to go back in time and apply a different smoothing method. So they're just estimates just to give you an idea of what contribution rates would look like if, one, we had the no asset smoothing, so basically what the volatility we are seeing in that market value translates to volatility in the contribution rates. And then the 5-year fixed smoothing has a little less volatility, and the 8-year is even a little smoother. So this gives you an idea of what resulting contribution rates would have looked like. I wanted to point out one very important thing. When we did these calculations, there are no rate floors in place, because if we applied the rate floor, you wouldn't be able to see what a smoothing method is really doing. So for LEOFF Plan 2, if we look at this period of time, you were always at the rate floor. So an asset smoothing method really would only be limiting your upward volatility. Okay, so because you've got that rate floor and that's where your contributions have been, the asset smoothing method really isn't doing anything in that period of time unless assets go up and cause contribution rates to go above your rate floor. Then the asset smoothing starts to limit that upward volatility.
Sorry, I have all the questions here.
Okay.
And what is our current rate floor right now?
The rate floor that's been adopted for long-term policy is 90% of the entry age normal cost rate, but the board has also adopted for in a short-term period 100%.
What
the
percentage rate
entry
is that?
age
I mean, so
normal
if I was to
cost.
look at this chart, it's around that no less than 7.5%, 8%. Is that what we're looking at, or what? How does that rate to these contribution rates?
The ones that we're showing in this chart do not have the rate floor applied because for us to be able to show you what the different smoothing methods could do to your contribution rates, we had to remove that rate floor. So I believe the rate was just below 8 during most of this historical period. Is that right, Steve?
The board adopted the time the board was created, the rate would have, that was being paid by the members was around closer to 5. The board adopted a policy to gradually move that up to the normal cost rate and then hold it steady at the normal cost rate, which right now is a little bit over 8.
Right. That's what I was expecting was that you could just draw a straight line around that 8% plus or minus, and this would have just shown you that if we just let it float, it could have gone as low as, on this chart, 2.5% and as high as 9.5% or something like that.
Right.
If we hadn't had those floors in place at the time. Right.
That's correct. Under these example smoothing methods, yes. So in summary, the asset smoothing method helps to manage that short-term volatility in investment gains and losses, which we know, market value can be very volatile from year to year. And that smoothing of that volatility also promotes stable contribution rates. As Aaron talked earlier in the presentation, there are many options available for a smoothing method, and selecting one includes considerations for your whole funding method. How is that integrating with the rest of your funding method? As Aaron talked about, the constancy, that sort of more long-term view of it. It's not something you want to be changing like every couple of years, and also including guidance from your plan actuary. As we prepare an actuarial valuation report, we do have to comment on the reasonableness of things that are in law, that we're not involved necessarily in making the decisions on some components of your funding method. We have to comment on the reasonableness of those. And in Washington, the smoothing method depends on the size of the change, so that dynamic that Aaron talked about, and the length of smoothing will not exceed 8 years, so from 1 to 8 years, and that 30% corridor that's in place. And that concludes our presentation, and we're willing to take any questions.
I think I know the answer, but I'm doing a self-test. So if the value of the assets go outside the corridor, it was 129%, say it went to 138%, then what happens?
Then the actuarial value would equal that 130% of market value. So the actuarial value would have been set at that 130% of market value. So if it was 132%, it would have been brought down to 130%, and that would have been the asset value that would have been used to calculate your funded status, your contribution rates. We'd continue those deferrals, continue to carry them through, but we wouldn't let that actuarial value go outside of that corridor.
But follow up on, Mark, I think what you're asking is that we would have to do something with rates. Isn't there, if we get down to those borders, we have to do, and then it calls us to do something about that, which is mainly about future contribution rates, right? I mean, if we get down to those corridors, then we need to do something else to make the plan whole again.
No, once you get to the corridor, that's just for setting that actuarial value of assets that goes into the calculation for the contribution rate.
Yeah.
Yeah, it doesn't require like any decision by the board. It doesn't require you to make any adjustments. It's just how much is being deferred and recognized, and it just gets limited.
Yeah, it would, in the case that you were talking about with 129 to 138, it would have forced you to recognize that 8% of losses, which would have resulted in higher contribution rates, because you would have had to, you couldn't smooth that extra 8%. You'd have to recognize it and start paying for it
That's right.
to stay in the corridor.
David?
So I know this is information only, and you started off by, Steve, saying that, do we have adopted policies that we're using the 8-year smoothing method, and this is a question of, should we change that policy? And everything I'm hearing is that steady as she goes. I mean, 8 years seems to be working well, and stay there.
Yeah, it was, the current smoothing policy was set in statute. It has been being used by the board since the board was created. It was set in statute before the creation of the board. So this was one of the purposes of this was to check in with you. You are responsible for the smoothing method used in LEOFF 2 and give you a chance to evaluate how you feel about the adequacy of the current methods. If you had any questions or any concerns about it, then we could follow up with that in terms of providing options or something like that for a potential change. But that slide that you had, Lisa, that showed the actual smooth returns using the dynamic, I think you saw that the smoothing method that's been used has actually been, judging by that, very successful. Now, there are pros and cons. One of the cons is you still have $581 million in losses. $1 billion of the losses from 2008 and 2009 you're still paying for. But so that's one of the cons. A shorter smoothing method, you would have had a 5-year smoothing method, you would have had that all paid for by now. But on the flip side, your rates have been extraordinarily stable. We've had part of the reason, one of the reasons for rate stability being a goal of the board was if rates are stable, studies show the sponsors tend to be more willing to pay the rates. And you have received your annual required contributions from the members and from the employers every year. And it's been a little bit rough and tumble at times, but you've also got the required contributions from the state every year, so not without some work. But as a result, you've been very successful. And so when you judge the plan by how stable your rates are, the percentage of the annual required contributions being committed, and even judging the funding status by a market value, not the smooth value, by all of those standards, anyone, I think, would judge your plan as being very successful. Lisa showed you at the last presentation a slide comparing how the different funding methods and how they've worked. I think the funding methods that you've used to kind of navigate 2008 and 2009, and again, the smoothing method's a part of that, as she said today. The results kind of speak for themselves. There may come a time where you're more interested in changing it. And Allison's presentation following up on this will be timely as well, because one of the, if your goal is rate stability, one of the things that can make that a challenge is investment return volatility and how you manage that. And so that's one of the things that Allison's going to be talking about, how the SIB portfolio creates or doesn't create investment return volatility. At least judging by the results over the last 10 years, it's hard to find fault with the current smoothing method.
Okay, any other questions? All right, Mayor and Lisa, thank you very much.
Yes.
Okay.
Kind of segueing into that, Mr. Chair, Allison Tucker from the State Investment Board is here, and although she's number 7 on the agenda, she's ready to talk now.
I'll need to catch my breath. I took 4 steps to this chair. Good morning. For the record, my name is Allison Tucker. I'm a Senior Investment Officer of Risk Management and Asset Allocation at the Washington State Investment Board. I want to thank you for the opportunity to allow me to come in and talk in a little more in-depth way about asset allocation at the WSIB, how we approach it, some recent changes that we've made. I've prepared a pretty, what I would call a pretty serious slide deck. There are almost 30 slides. I'm trying to keep my prepared comments to 30 minutes so that you can ask questions if you feel like it at any time, of course. So I won't be able to go into a huge amount of detail on all of these slides, but hopefully the overview is informative for you all. So I'm going to start. The agenda is on slide 2. That's for your reference so that you can see the path that I'm trying to take in the discussion. We're going to start with an overview of the CTF using some slides I think you've seen many times before, but we have updated data that you might be interested in seeing. Then I'll move into the definition of asset allocation. What is the process at the WSIB? What are the key considerations that the board makes when they set investment policy? And then address some specifics about the volatility of returns and a comparison with other U.S. public pension funds at the end. So starting on page 3. This is a slide I'm sure you've seen before. This shows the state assets that the WSIB manages in total. You can see that we are now, well, as of September 30th, we were about $95 billion in assets, the bulk of which, $71 billion, or about 3/4, is invested in the commingled trust fund. We also manage assets for many other stakeholders. We perform asset allocation studies for those stakeholders as well, sometimes in conjunction with consultants, sometimes on our own. And the bar graph at the top shows you just pictorially the division of those assets and the size on a fiscal year basis over time. Page 4 has some performance information. This has our most recent quarter end. So if you look in the bottom right-hand chart and you see the line total CTF at the top of that table, you'll see the 1-year return as of September 30th was 12.6%. We encourage everybody to focus on the longer-term numbers because that 1-year and 3-year number set can show a lot of volatility. But if you focus on, say, our 10-year return, you can see that the CTF has exceeded its 8% or 7.9% actuarial rate of return assumption. The box directly above it is the actual allocation of the CTF as of September 30th. You're going to hear me talk about long-term targets because that's how we set investment policy. But the actual allocation from time to time does differ materially from the targets. And I plan to go through each of these asset classes in a little bit more detail, hopefully not too much detail. My challenge is always that I'm fascinated by these topics, and so I have to remember not to go on and on. And then the bottom left-hand chart, the historical fund returns, that's a fiscal year basis. You can see what the 1-year returns are on a fiscal year basis. Most of those bars over this period, this 10-year period, are pretty high returns with the exception of the major downturn in 2009 that you all experienced and we're just talking about. Page 5 is a composition of all the stakeholders within the CTF. I'm sure you're aware of this, but we have 14 defined benefit plans that are invested in the CTF and 3 defined contribution plans that invest through their election of the total allocation portfolio through their DC plan. And then we've highlighted the LEOFF plans 1 and 2 that comprise almost 20% of the CTF. And then you could also see that the largest plans within the fund are the PERS plans 1, 2, and 3, which make up almost 50% of the fund. So that's the overview that I know you're already familiar with. Moving on to asset allocation and what it is and why it's important. I know slide 6 just has a quote on it, but this is a very important piece of research that came out in 1986 by a gentleman named Gary Brinson, and he and his co-researchers investigated 91 large U.S. plans and their returns, and he found that almost 94% of the variation in plan returns was actually explained by asset allocation, or the mix between different asset classes, such as stocks and bonds. Now, the prevailing wisdom up to that point was what mattered most to a plan was whether you picked the best stocks within the stock market or the best bonds within the bond market. And what Gary Brinson found is that, no, really, it has a lot more to do with your mix between stocks and bonds than which of those securities within those classes you've selected. And so it had a big impact when it came out. It's continued to have impact. It's now the prevailing wisdom within the industry that asset allocation is, or investment policy is the key decision that fiduciaries make. And Gary Brinson has come to be known as the father of asset allocation because of this research. Slide 7, I've sort of given away the punchline here, but asset allocation is the process. You divide a portfolio into its different asset categories, or asset classes as we call them. And as a staff member at the WSIB, my role is to lead the organization's efforts through that process of determining what the most appropriate long-term mix of asset class investments is. And we just happen to have gone through this process over a year-long period, and that's why I have some current examples and some fresh information to share, which is in the back, where I can walk you through exactly how we go about doing this. The foundation, though, of asset allocation is this concept of diversification, and it means exactly what it sounds like. Don't put all your eggs in one basket, and I'm going to talk to you a little bit more statistically about how we define that. But that is the key point with strategic asset allocation, that you're not overly exposed to one outcome. You're exposed to a range of outcomes so that you have an ability to withstand market cycles and periods. The board has adopted a formal CTF asset allocation policy. You can find it on our website, and it calls for a formal review of the asset allocation policy or the investment policy at least every 4 years. And that's typically when we do it, although we have done interim asset allocation reviews when the market required it or some other reason required it. So I'm on slide 8 now. So I talked about the process, or the objective of trying to find the most optimal or most appropriate long-term mix of asset classes. This is a general framework. I'll try to make it more specific to the CTF, but it's a general framework that explains the key considerations under an investment policy or an asset allocation decision. And first and foremost, there needs to be an understanding of program goals, and you can go through a variety of processes to figure that out, but that translates into a return objective ultimately for the assets under management. For the CTF, this is a more simplified process because we have a legislative mandate that calls for us to maximize returns at a prudent level of risk. So that is the return objective. We also have an actuarial assumed rate of return that serves as a return objective as well. And then you have to go through a process to determine the risk tolerance of the stakeholders. And Generally speaking, in an asset allocation framework, we're talking about the volatility of returns, and I'm going to define that for you and talk about why that's important in asset allocation. But that is the key risk measure in an asset allocation modeling study. Of course, there are other investment risks to take. Oh, yes, I'm sorry.
Thanks, Alison. Just
Sure.
one question.
Yep.
When you talk about program goals and the rate of return, so we're at 7.5%, 7.98%, depending on which plan we're looking at. But how is that compared to other states, or is that an aggressive goal? Or when you're looking at the previous slide talked about 91.
Yeah.
Is that a typical goal for a large fund like this?
I think with few exceptions, you would find that all the U.S. Public pension plans are somewhere between 7.5% and 8.5%. So it's typical. I appreciate the question. I don't mind that I can't remember where I was. No, it's fine. So there were other risks that we take into consideration outside of the modeling framework. But when you and I'll talk about those two. But the volatility is really the key risk measure in terms of setting asset allocation policy. And then there are many, many other considerations to take into account when you're thinking about what's the optimal mix of investments. Time horizon's a biggie. The more time that you have to withstand different markets, the more risk you can take on. I think the CTF is an obvious example, but maybe a more simplified example would be to be thinking about maybe a young professional without a family, having just graduated, in savings mode versus a retired couple that are much more concerned with preserving their capital because of the maybe the lack of income or shorter time period. So your time horizon feeds directly into your ability to withstand certain investment risks. And we're fortunate at the WSIB that we have a board that is very focused on long-term outcomes, long-term positioning, as opposed to much shorter time periods. And that helps us tolerate higher levels of volatility than maybe some other plans, which you'll see in the peer comparison. There are also liquidity constraints. The stronger need you have to manage your liquidity and to provide liquidity, that's going to have a direct effect on what your investment policy is. And so you take that into account. Other circumstances or preferences might have to do with tax implications and other things that don't apply to the CTF. Slide 9 talks about strategic versus tactical asset allocation. I tend to say asset allocation, and I'll say at this point and may never say it again, what I mean is strategic asset allocation. This is long-term investment policy, putting a portfolio together that is able to withstand several market cycles, downturns, upturns, without having to make large changes to the policy. That's in contrast to tactical asset allocation, which really is a more dynamic approach where organizations may look at the current market environment, try to position the portfolio to take advantage of opportunities, say from as short of a time period as a day to maybe 3 or 4 or 5 years. That is a completely different approach. It requires different tools. Many organizations do that. Few do it very well. Few do it well, and I think the evidence is clear that pension funds in particular that try to be market timers or do a lot of tactical asset allocation tend not to be very successful with that strategy. So we use a longer-term 15 to 20-year approach to strategic asset allocation, and we think it's served us well and tend to stay on that course. So here's the part where I'm going to try to be as brief as possible. We have 7 different asset classes within the CTF. I'm guessing that you all are, have talked at length about a lot of these different investment classes over time. So I'll just try to give a brief description of the role that these investment classes play in the portfolio. And these are listed in order of lowest risk to highest risk, with the exception of the last two. So the CTF has a 20% long-term allocation to fixed income. These are debt securities of companies and governments, and some securitized securities. And the purpose of the fixed income portfolio, it happens to be an area of core competency for us, where we've managed to, over a long period of time, produce very strong returns here relative to the others in this class. But its role in the portfolio is to provide liquidity when we need it, and also diversification. So fixed income securities, not all of the time, but typically speaking, when you need it, when your equity portfolio is in some type of crisis, the fixed income portfolio tends to provide very strong returns during that period. So that's the type of diversification that we're talking about. Tangible assets is our newest asset class. It was added in 2007. These are investments in real assets or producing assets. It has a 5% allocation in the CTF. It's currently in ramp-up mode, so its actual allocation is significantly lower than that today, but we're building the team there. There's a lot of action and momentum right now, so I think you'll see that allocation grow over the next 4 to 5 years. But they buy things like farmland, timber, infrastructure, and the goal of that program is to provide an income stream that's higher than fixed income, but probably lower than real estate, with a lower level of volatility in that return stream. The real estate portfolio has a 15% allocation, and we think we have an innovative approach there. We have folks that are out all over the globe looking for properties to buy on our behalf. These aren't fund structures. They're working in our interest. And they also take a kind of a unique approach to strategy, which I won't go into, but the profile of this real estate program looks a lot different than you might see from a different institutional investor. And there are no, at this time, there are no, I get this question a lot, but there are no single property homes like you or I might live in. They're looking at commercial type real estate, warehouses and things of that nature, apartment buildings. Public equity is the next class. This is there is a 37%, I'm on slide 11, 37% allocation in the CTF to public equity. It has a global benchmark, meaning we don't overemphasize the United States here simply because we're located here. It is all managed externally, meaning we hire managers to manage the equity exposure on our behalf, and it is about 60% passive, meaning it is expected to mimic the global market as opposed to try to beat it. Just get as close to a return as possible to global markets, which includes the U.S. and all non-U.S. markets that are investable, including emerging markets. And then private equity has a 23% allocation in the CTF, and there it's 100% managed by external parties as well. We invest through a fund structure, and we were one of the very first institutional, I'm sure you know this, but one of the very first institutional investors in private equity back in the early 80s when it really didn't exist yet as an asset class. Because of that and because of the board's strong commitment to this asset class and to private markets over a long period of time, we have developed a strong competitive advantage here, and we have some very high quality relationships that we may not have had if we hadn't gone into this so much earlier. It has been a key driver of performance of the CTF over a long period of time. Innovation, it's a small portfolio, 0% target. It can be up to 5% of the CTF. That's just a place where staff can bring ideas that aren't specific to another asset class to develop them, see if they can be turned into something larger, or maybe into an asset class, or incorporated into one of the other programs. That allocation tends to be quite low. We're very busy doing all the other asset classes, and opportunistic investments don't come along all that frequently. And then finally, cash. We have a cash allocation target of 0, but we can hold up to 3% cash, and that's used to manage the cash flows of the fund, which go beyond payments to beneficiaries, but also funding our external partners in the private markets. So switching gears a little bit, slide 12, I'm going to go through briefly how we build capital market assumptions. And the reason I'm choosing to do that is that the board periodically adopts a set of capital market assumptions, and those are forecasts of risk, return, and correlation behavior of the asset classes. And when we have that set of forecasts about the future, those become a key input into any asset allocation process we might do. We just used the 2013 CMAs to do the asset allocation for the CTF, and any future capital market assumptions we will use to do the modeling for other stakeholders as well. And we spend, the board spends a lot of time going through this process and having discussions about how we come up with these numbers. I'm going to go through it pretty quickly, just because, again, this is one of those fascinating areas where I could go on, but I don't want to. I don't want to force all of you to do that. So there are 3 inputs to capital market assumptions. There's a return forecast, a risk forecast, and a correlation assumption by asset class. I'll define each of those things individually. So page 13 shows the return, and what our board adopts is an arithmetic return, which is the return you might expect to achieve in any 1-year period. This is distinct from a geometric return, which is what I showed you in the beginning slides of what an investor would have earned. And I'll just give you a quick example. If you made a $100 investment and you lost 50% 1 year and then gained 50%, the simple average is what we know in our daily lives. You take the return series, add them up, and then divide by the number of numbers. So a simple average would tell you earned a 0%. Plus 50 minus 50 divided by 2 equals 0. But you and I know that if you gave me $100 and I lost 50% of it, you go down to $50. And if you gained 50%, you gain $25. So I would hand you back $75 and say your return is 0. You would know that's not quite right, that in fact you were down 25% and you were missing your $25. The difference between those, they're really meant to describe different things. One is what's the performance over the period. That's the down 25% geometric return. And what might you expect to earn in any one single year? That's the 0%. And so we asked the board to look at both of those numbers. They're both important, but in a modeling process for asset allocation, it requires the arithmetic return. And for the S&P 500 at the bottom, you can see the arithmetic over this time period was 11.8%. But what an investor would have earned had they held that security that whole time would have been 9.9%. And the mathematical linkage between the two is the degree to which the returns bounce around or its volatility. So we come up with assumptions, return forecasts for equity or for the S&P 500 in this example, using a huge amount of data. There is a strong historical bias in the number, meaning generally speaking, we think that there are patterns in history, and we try to reflect those in our forward expectations. We also take into consideration the current market environment, valuations, a number of other factors that go into that to come up with a return forecast. And the return forecasts that our board adopts are for 15-year time periods, not a 6-month or a year or 3 years or anything shorter. So this is a picture of what I mean by the arithmetic return. So we're forecasting a risk number for each asset class, and in the investment industry, the way we describe volatility is through standard deviation. And so what you see here is a normal curve pictured on the bottom, and that center line in the middle is the arithmetic return, or the median, the average. And the little alpha symbol next to the 1 down there, that's the symbol for standard deviation. And what it says is that within 1 standard deviation, you would expect 68% of the time going forward that your return would be within 1 standard deviation of the average. A normal bell curve has these statistical properties. Same goes for 2 standard deviations. 95% of the time you would expect that return average you're looking at to fall within 2 standard deviations of the average. So just a quick example, if your average return is 5% with a standard deviation of, say, 2, 68% of the time you'd expect that return to fall between 3 and 7%. To get to 2 standard deviations, you multiply 2% times 2, so you have a 4% number. 95% of the time, you would expect that return to fall between 1% and 9%. And so standard deviation is a measure of dispersion. The higher the standard deviation relative to the mean, the wider your potential outcomes are expected to be. I'm actually going to, I should have put these in a little different order. I'm going to go to slide 16, and this is just an illustration of why you have to look at not just return, but also you need to look at your standard deviation. So the graph on the left shows 2 investments with one with an 8% expected return, the other a 9%. If you didn't know the standard deviation, you would always favor the higher returning security or investment. The fact is, once you take into account the 2 different standard deviations, they should produce the exact same investment result over time. So you would actually be indifferent between these 2. And that's why it's important to look at both, which is what we show our board. And somehow I am running low on time, so I'm going to have to pick up my speed here a little bit, or skip some things. Going back to slide, I went the wrong way. Going back to slide 15, correlation defined. Correlation is just the degree to which asset classes or securities move either together or apart from each other. It ranges from a plus 1.0 or 100%, meaning perfectly positively correlated, they always move in the same direction, to negative 1.0 or negative 100%, meaning they always move in opposite directions. And it doesn't say anything about the strength of those moves, but if I have a stock that when it goes up and I have another stock that has always gone up at the same time, I know those things are related. Ideally, you construct a portfolio using the lowest correlations as possible, which means that you're not exposed to any one outcome, that you'll have some part of the portfolio doing a good job while another part may not be doing as well. In reality, it's very hard to find certainly perfectly negatively correlated investment strategies are almost impossible, but even low or negative is getting harder and harder. That's one of the challenges we face. But that's the concept of diversification. You want things that are performing differently together. And then our process for coming up with these recommendations for our board is very simple. We ask a large number of consultants to produce their estimates for us and their methodologies behind it. Staff will evaluate the reasonableness of those and the assumptions underlying them. we might incorporate our own views into these numbers. And then finally, we will customize these return and risk expectations based specifically to the way that our portfolio is constructed, which, a consultant might have a much more generic return assumption for fixed income, for example, whereas we have a very good understanding of what that portfolio should do over time, and in a way that we can craft a better estimate, in our view, than what the consultants provide. And we show all of that to the board before they vote on it. And then considerations that are always important when you're modeling, and I may say this again later, these are just their expectations. They're meant to provide context for a range of future outcomes. They're not specific numbers. The CIO, Gary Brubaker, likes to say the only thing we know for sure is that we'll be wrong. And so there is a lot of assumptions in this process, a lot of subjectivity, but still a good framework despite those caveats. Slides 18 and 19 are just meant to show over time, over the last 13 years, what our how much or how little our assumptions have changed. And if you look at the U.S. equity assumption, the graphs, or the line graphs on the bottom, those are the geometric returns over time, expectations, and you can see that we typically are more conservative than the consultants in this asset class. We're the dark blue line, and that the returns have, with the exception of the spike up in 2009, the returns have generally been falling over time. And I'm sure you've heard that return expectations are lower today going forward than they have been in the past, and this is one reflection of that reality. You see it a little more so in the fixed income assumptions over time, which is on slide 19. Here we tend to be a little bit more aggressive than the consultants, a little higher than the consultants, and it's for those reasons I talked about, where they're using a more generic assumption about a fixed income return, whereas ours is highly specific to what we do at WSIB. But we get asked that question a lot. What are you doing to respond to the current market environment? This is one way to show over the last 13 years, our return expectations have been coming down, and that's consistent with the market environment, interest rate levels, et cetera. Slide 20, I included this for your reference and also so that you could see what our board ultimately approves. There are a number of asset classes on the top left-hand side in the blue chart. You can see the arithmetic return, which I need to be able to do the modeling work. There's a standard deviation assumption, and then the connection between the two. For informational purposes, we provide a geometric return, which represents a compound return over time. And then the bottom table has the correlations. And generally speaking, you wouldn't expect these numbers to change significantly from year to year because they're long-term forecasts, and they generally don't. As you saw in the other two graphs, they change gradually over time. So slide 21, I mentioned that the board just went through an extensive asset allocation study for the CTF, and I wanted to include the next 4 slides just to show you the level of depth that the board went into and the level of work that they did to come up with the new investment policy. And we started it really in July of 2012, and we have a board meeting tomorrow, and if the policy is approved tomorrow, we get to say that it's finished over that period. If not, it will keep going. But you could see in the table on the blue box there, you can see all the topics that the board has addressed. I'm not going to go through each, but they have to do with evaluations of liquidity risk, plan risk. The board had asked us to look at what other pension funds are doing in terms of their asset allocation process, what innovations in the industry might we discover. We did an extensive review there in May and learned that we're doing just fine compared to our peers and others. And then in July, we had a number of discussions. We had a much longer period with the board, a full day and a half, discussing various aspects of the asset allocation study. And then we brought a recommendation in September, which was approved. I'm going to focus, just as an example, on the one quantitative process that the board went through, which was the way I talked about. You need to understand the fiduciary's risk tolerance when you're your stakeholders' risk tolerance when you're formulating investment policy. We have a pretty it's not unique, but a rare process at our board where we go through a quantitative modeling process to capture that risk tolerance. So I just brought an example on slide 22. And I'm not going to go into all the detail, but if we focus on the most important box, which is the upper left-hand one, the voting board members, if you look at the inner ring, which is the dark blue labeled protection-oriented 34%, and then return-oriented 66%, that is showing the breakdown that after going through this process, how the voting board members expressed their goals for the program. So almost 2/3 of the impact was meant to be directed towards return, which makes sense. Our central mission is to maximize return at a prudent level of risk. And then the other approximately third was to investigate or apply investments that would protect the portfolio, either from a volatility perspective or some other perspective. And if you want to look at the outer ring, it will show you a breakdown of what the board was voting on. But the key point here is that we were able to take that voting outcome based on the aggregate voting board members model an optimal portfolio, which is what you see at the bottom here. And that portfolio does not look that different from the one we had in place at the time. But then staff took this quantitative perspective back to the office and thought about other key considerations that need to be made in order to turn this optimal portfolio into a recommendation to the board that reflected their full risk tolerance, not simply just the voting. And that those key considerations you'll see on page 23. There were really just two qualitative adjustments that staff made to that optimal portfolio to bring the recommendation to the board. And they were around liquidity and implementation that quantitative process did not capture very well. And the liquidity component is that we have a significant private markets allocation, and by nature of the asset class, it's much less liquid than the public markets allocation. And while the voting board members expressed a desire to maintain liquidity in the fund, for whatever reason, the optimal portfolio result actually decreased the public markets allocation in favor of private markets allocation. So one of the adjustments staff made was to bring that back to the existing ratio where it was, rather than make the fund more illiquid. And then around implementation, there were two thoughts there. They're very simple. We know the board has a significant commitment to private markets, so we made our adjustments there. We have an innovative strategy in real estate. We knew the board wanted to show more support for that asset class and allow it to grow, modestly over time. And then also we have a large and growing private equity program, and the board was clear in their feedback that they wanted to maintain the quality of that program as it grows. And so those three modifications resulted in the recommendation we made in September, which was approved, and that was to increase the increase the real estate allocation from 13% to 15%, and to fund that by reducing the long-term target in private equity by 2%, from 25% to 23%. So this is a very modest change to the asset allocation for the reasons I just described. No other asset class targets changed. The ranges didn't change. Adopting this type of modest alteration of the long-term policy does not meaningfully change the risk-reward profile of the CTF, although I think it does address those implementation and liquidity concerns very well. We're bringing the policy to the board tomorrow for approval, and if it's approved, this is what will be the new policy, what you see under proposed. So that's the change to the asset allocation. Talking specifically about volatility, this chart shows the rolling one-year return of the CTF since inception, and you can see that it moves around a lot. But the point that we make with this slide is that these colored bands represent the capital market assumption range of outcomes, and the white line has, with the exception of this 08 to 09 period where it barely falls outside of the colored area there, we have been within a very reasonable range around the average that we would expect. So there is volatility here. It's painful when you go through the downside of it, but we have recovered, and we think this is a consistent return profile given the expectations that the board has set through the capital market assumptions. And then the next two slides show the results of a study. We didn't do this. This was Goldman Sachs Asset Management. They did all the work behind this. So I think the numbers might be a little different than what you see from us, but I think the point is really just the relationship of these pension funds. I don't know why they picked the ones that they did, and I know they're in acronyms, so you may not recognize all of them, but these are very large U.S. public pension funds that they're using as this peer comparison. And you can see the WSIB is in that dotted line box on the left. And this graph says that we are expected to have the second highest return of this group based on their capital market expectations lining up with our asset allocation. And if you go to the next page, it says, as you might expect, that we also have a profile that is the second, it should be the second most volatile based on this picture, but I'm noticing now that under the SWIB, the Wisconsin board, their number says 14.2. So that one's out of order or wrong. But second or third most volatile, by this measure of the funds. So higher risk, higher return profile for the WSIB. And then I'm going to skip slide 28. 29, we've talked a lot about volatility because that's the key risk measure within the asset allocation framework, but certainly there are many other risks to consider. You saw some of these risks show up on the table where the board engaged in more in-depth discussions around some of these topics. They're just listed here for your reference and to give you an idea that it's not solely the volatility of returns that we're concerned about. And that was all I had prepared. Is anybody awake? That's a reflection on my presentation, not on you guys.
Allison,
Yeah.
Could you go back to a couple of slides to the one that compares the volatility of there you go.
Mm-hmm.
This kind of, for the board's perspective, as you adopt your policies around things like a funding method, a smoothing method, that where one of the characteristics of those funding methods or those smoothing methods that you adopt is how well they handle or how poorly they handle volatile investment returns. It's important to you to understand, well, how volatile do you expect the investment returns here in Washington to be? You don't invest the assets, the SIB does. And this is sort of their message to you on here's what to expect and here's what to prepare for as you go about setting policies in your area of responsibility. I want to thank you because this is the first time that the board has ever seen this type of presentation and specifically this type of slide with some kind of quantification of what that risk looks like, and in particular what it looks like compared to peer plans around the country. And so in general, if you can see that, as Allison pointed out, you're got the second highest risk profile, you've got a great investment return profile, also the second highest, but how do you manage that volatility in order to accomplish your goals of rate stability and full funding? So again, this was very informative, and it's the first time that the board has ever seen
Okay.
it. So
I
thank
didn't-
you very much.
You're welcome. I mentioned that these numbers are different than what we might come up with because it's the Goldman Sachs methodology, but I can comment and say that the expected volatility number, we do calculate that for the board as well. And the modest allocation change that was approved in September, moving 2% from private equity to real estate, does have a dampening, a very small dampening effect, but we calculate the expected volatility at around 13.9%. So it's pretty consistent with the number you see here.
Are there any other questions for Allison? Okay. Well, thank you very much.
Thank you.
We appreciate it. I'll wait till Allison leaves the room before I say, boy, we need a break, okay? Thank you, Allison. Okay, why don't we take about a 5-minute stand-up stretch, use the facilities, and we'll reconvene at 11:10.
Mainly driven by the change in investment return. Also, one big difference is that when the original factors were done, there was no subsidized early retirement, and that's the provision in Left Plan 2 now, that if you have 25 years and are age 50, or is it 20? Thank you. I looked that up yesterday. Then you can retire prior to age 53 and have a 3% reduction instead of a full actuarial. So that's what's meant by the subsidized early retirement. That cost hadn't been included in the prior factor, so that's part of the cost change as well.
All right, so on that slide there.
Oh,
Uh-oh, uh-oh.
5, okay.
Okay, there's a long ways to go to say that this person gained enlightenment and came back as a firefighter after having left as a law enforcement officer.
Well, I wanted to have a balanced example.
Okay. Thanks for your help, Paul. The timing is horrible.
Like I said, I've still got some technical issues to work out in my training, I can see that. So when the board did the factors last year, they decided to go ahead and adopt them on the same effective date as DRS. So DRS does the factors for all other plans, and of course, you folks do the factors for Left Plan 2. So DRS is currently working on adopting these same factors for the other plans. Their plan is to have them effective October 1st, 2014, so there's enough time for a rollout and people can be aware they're coming. And there's a difference in the cost, so it might affect for some people their decision of when to take this action. Obviously, if they're thinking about doing this, it's going to be cheaper for them to do it before the new factors come into effect. So the options for the board under this is, if you want to track what DRS is doing, you wouldn't have to, but you could publish the new factors on the website. And I should say, these are not going to go into WAC, so there's no formal WAC adoption process here. It's just a question of providing notice if you want to do that. Then you could adopt the restoration factors in December to be effective October 1st, 2014. Theoretically, you could adopt them next summer, but that wouldn't give as much lead time. DRS is planning to adopt their factors in February, but of course the board doesn't meet during session, so we can't quite track there. And then the other option would be to retain the current factors. And taking action, that would not require a motion. Option 1 would require a motion. Any questions?
Any questions? All right. Seeing none.
If you want to move this issue forward, it would take a motion to put it on the agenda for December, and then you'd actually be voting on whether to adopt the factors or not at the December meeting.
Okay, it's been moved. Is there a second? Okay, moved and seconded. Discussion. So Steve, under these two options, I understand you said we would move this to
Right.
final for the next meeting.
So we'll be explaining those. We'll be explaining those two options to you in detail at the next meeting. You'll be actually voting on them at that time.
Okay. All right, so the motion is to move to final, and if there are no other comments, we'll move to the motion to adopt. Okay, all members present have voted, and the motion passes, and we will move to final for the next meeting. Okay, Paul, we'll move on to item number 4.
Thank you. Again, for the record, my name is Paul Neal, Staff Counsel, talking about promoting individual savings for retirement. This is a follow-up. We've talked about this twice before, once at the August meeting and then again at the September meeting. The basic issue is that there are some new IRS rulings and statutes that provide new options for managing savings in retirement. The question is whether the board wants to look at that. Basically, these are things that can be done that are now allowed under federal code that have little or no cost to the system. We've been talking to DRS, and they haven't identified any big cost issues, but I do want to say that they haven't also done a fiscal note analysis yet, so that potential is out there. Again, just for way of refresher, the 2012 IRS ruling that said you could have annuitization of tax-deferred savings within your 401A plan. So you could basically roll money over from your 457, annuitize it, which the department does at a better methodology, or a methodology that results in a larger monthly benefit than if you were to buy that annuity on the private market. And that's something that can be done, but would require a statutory change. Another thing that we didn't talk about before, and this does not necessarily require legislation, but the 2010 Small Business Jobs Act allowed 457 plans to adopt what's called Roth provisions, and Roth is just the name of the Delaware senator that introduced this. It's not an acronym for anything. Basically, it takes the usual tax-deferred savings plan and turns it on its head, where the money is taxed when you contribute it, but when it's distributed, both the original contributions and the assets are not taxed. And DRS could authorize either or both of these. One is to contribute on a Roth basis, which is basically it'll be taxed when you contribute it, or it's also possible to convert your current balance to a Roth account. Like if you've got $20,000 in your deferred comp, you can convert it. If you do that, it's taxable in the year of conversion. And again, from talking to DRS, this is something that they're aware of and that they have been thinking about. It doesn't require legislation to do that. This is within the scope of their current authorizing authority. So I wanted to get back to the options that you had asked for more information on from last time, and one of those is the authorizing the annuitization of a rollover of tax-deferred savings. There was a couple of questions that I didn't have answers to last time. One of those is that the permissible rollovers can come from any tax-deferred savings plan, 457 or 403B or some other 401A. There's no IRS limit on the amount you can annuitize, and this is different from the current law provision that allows you to buy airtime, which has a limit of 5 years, which for the, quote, average left to member is about $80,000. There's no limit on the amount you can annuitize. The limitation that is in place is the overall Section 415 limits, and I'm not sure if the board members have been briefed on those before. In a nutshell, you can't provide more than a certain amount per year through a DB benefit under the IRS, and that amount right now is $205,000 a year. So I don't think that's going to be a huge issue for most people. But I guess if you had $1 million in your 457 plan, you know, that might be a problem. But the other option, which I've kept the old numbering, so even though it's the second option we're talking about, is actually option 3, which is requiring LEF employers to offer DRS's deferred compensation program to LEF members. And then the thinking behind this was that the fees are significantly lower in the state's deferred comp program, and that leads to a greater accumulation of assets because the fees are lower. We have some draft legislation. We've given a DRS for review. I would note that at the last Select Committee on Pension Policy Executive Committee meeting, DRS's Director Marcy Frost asked the Select Committee to consider a similar provision applied to all plans. Of course, the scope of this board is strictly LEF Plan 2, but there is some interest in it, and apparently the governor has some interest in that as well. So that's what I'm calling option 4. This is new. It wasn't up last time, but this has to do with this Roth information that we've gotten. Implementation of a new option to authorize Roth contributions to DRS's deferred comp plan, 457 plan. You could either direct us to draft legislation requiring that. Again, it doesn't require legislation to do it, but just requires DRS to do it. So the board could ask DRS to exercise its authority to develop that option, or you could take no action at this time. All those options are freestanding. They're not, it's not like if you do one, you can't do two. You can do any of those. So bring any of those to you for a vote on possible legislation would require a motion at this meeting to move forward for the December meeting. And if there's any questions, I'd be happy to answer those.
Yep. Paul, can you back to option 4 there on?
Oh, okay. Thanks.
Great.
Do you really want to ask a question, or you just want to see me try to do it?
Yeah. No. What is, go back and what is required here? You said doesn't require any legislation, just the request for DRS to offer this.
There's 3 possibilities. For today, what we're asking the board to do is if this is an interest that, or an issue that you have interest in that you want to vote on in December, then include that in the motion to move this to a final presentation in December. And you'll actually be voting on all of these options at December for final passage. But going down that path, if the Roth is something you're not sure about, one way or another, you could decide in December to do nothing. If you want to guarantee that it is offered as an option through the state's deferred compensation plan, then you would have to do it legislatively. It's in the current DRS authority, though, so if you, another option would be simply to, ask DRS to exercise their authority to include this moving forward. We're not asking you today to choose how you want to move forward specifically on Roth. What we're asking you today, though, is if Roth is something that you might want to move forward on, then include that as part of your motion for staff to bring to you in the final presentation in December.
Okay, so I guess my question, maybe it's more opinion, but why would we not create this opportunity for a Roth if it, I mean, the options, what are the options we have now? Like David, as example, who does it for City of Tukwila now?
Yeah, and I don't know that answer, but that's exactly my question, is that why wouldn't we give more options to our members? I mean,
The opportunity to defer.
I mean, I don't hear any financial bit on the left to plan. This is just giving more options to our members, and we'd want as many options as they'd like. So going to option
Good-
at
good
least 4B.
options
Yeah,
anyway,
well,
yeah.
we'd like good options, yeah.
Okay. Is there a motion or further questions of Paul? Mark?
I have a question on option 1. Does that require legislation?
Option 1? Yes.
Yes.
That would, to have it annuity, it'd be similar to the language that's in place now for the Plan 3s, where they can do this, where they annuitize the deferred compensation account. So it would require legislation. Yes.
Yes, the tricky thing about option 1, you can require the Department of Retirement Systems to include the annuity option, or to provide that annuity option out of LEOFF Plan 2. And then anybody who's got a 457 plan would be allowed. And for what we understand, for most, if not at least for the vast majority of LEOFF members, you have some kind of 457 plan. We weren't sure. There may be some that don't, but most of you do. So the key piece on option 3 would be for maybe that small group of members who don't have any 457 plan offered through their employer right now, they would be required to get at least have the state's plan as an option. But for the vast majority of LEOFF 2 members, it would be simply guaranteeing that the state's 457 plan is an option for all your members. So for instance, a city currently might have ICMA, or they might have Nationwide, or they might have Great Western, or any of the other providers, but they may not offer the state's plan as a choice to members. This would be requiring that the employer offer the state's plan as an additional choice. And then the members could choose between them based on fees and investment choices and so forth. But it would require that the employer offer it as an alternative.
Steve, if the employers are getting a rebate or whatever or from the plan?
That's a question that's been brought up. Some of the jurisdictions and 457 plan providers have worked out agreements where the provider would say, I'll give you a break on your fees if you agree not to offer any other plans except mine. And there are some of those exclusivity agreements out there. And then some of the questions tend to come up is, as time goes by, how do you know that the fees change? Most of you have gone through that with medical insurance providers, for instance. They'll come in with one fee that's lower, and then 4 years later, they're the same as everybody else. But so there's that, but then there's a question of if the state required that as an option, would that violate any of those agreements? It's not an employer choice. That would be something that would have to be sorted out through the legislative process in all likelihood. I don't think there's going to be a definitive answer to that question anytime in the next before session in any event. But we can talk about that specific question more in December, have some more info for you.
Would all these be combined if we did option 1, 2, and 3? Or 1, 3, and 4, I mean?
Yeah, any options that you approve in December would all be rolled into the same bill.
David?
Does Paul know how to count? Because option 2 is missing.
I'll talk to him about that.
Okay.
I do have a bachelor's degree in economics, so.
On option 3, the only one, I didn't realize we're requiring LEOFF employers to offer that, so I misunderstood that. And Kelly, to your point, we do offer like 3 different programs. And the one question I would have is that, Tequila, I'm sure that we'd be able to add one more program to that. If the question I have is really for some smaller jurisdictions. I don't know if the state is going to administer it and the state is going to provide that. There is a implementation piece. I'd like staff to make sure that we understand what is being asked of us. It may not be the LEOFF 2 plan, but if we're pushing additional administrative tasks on to employers. And like I said, Tukwila, we have 3 plans, and I think that's probably a few too many, actually, just because it gets confusing with our own members, is that we have, just this last month, we have 2 of the plans that came in, and we had 20 people here, another meeting. I'm not sure if offering 4 plans does much for us individually, but I'm thinking of a smaller jurisdiction. I don't know if they have 1 or 2. That would be the question I'd have from staff, is that I like it an optional thing, and we want to make sure we have those options, but implementation is a concern of mine.
And that, again, that's a fair question, and we'll try to have more assessment of that impact for you at the December meeting as best we can. I'm not sure how much of it we can nail down before session.
Okay, further questions? Mark? Okay. All right. Okay, moved and seconded. Further discussion?
Just with that caveat that we look at the implementation piece on, especially option 3. I'm not sure about, it doesn't sound like the option 1 and 4 had as much implementation issues, but whenever I heard the word require, that kind of gets me going a little bit more, just wondering what that full impact is.
Okay. That'd be a part of the next presentation, correct?
Yes, and
Okay.
You'll be voting on each of the options individually at December as well.
Okay. All right. Do your voting. Okay. All the votes have been counted, and the motion carries, and we'll bring it to the December meeting. 5?
Yes.
Ryan?
By way of introduction, item number 5, the Washington State Institute of Public Policy Study follow-up. Earlier this last interim, you heard a study from the Washington State Institute of Public Policy on public pension plans in Washington, including LEOFF 2. They had a lot of study results, and you had a lot of questions as a board for other things that you wanted us to look into in more detail. There was a follow-up earlier this interim, at which time you guys provided some specific items that you wanted us to follow up on, and this is the result of that request earlier this interim. So with that, I'll turn it over to Ryan.
Thanks, Steve. For the record, Ryan Frost, research analyst for the board, and as Steve said, this is a follow-up to the June presentation that the board made on the WSIP follow-up. So the original report was presented 2012 board meeting, December. The focus report was on benefit levels, portability, and excess comp. Specifically for this presentation, we're focusing on the benefit levels piece. What we really talked about was the danger of judging plans based on one factor, which is what the original report did. They judged plans on income replacement solely, and left rank 31st out of the 43 plans that they covered. And as Steve said, there's some further options presented that that we thought should be studied and looked at to gauge the success of a plan. So the first factor we looked at was membership by plan. You'll notice LEOFF 2 in the red on the far right is on the lower end of membership. Some of these plans with 100, 2,000, 300,000 members are your Florida retirement systems that aren't separated out by just police and fire plans. So that's kind of where the discrepancy lies in there. Average yearly benefit, LEOFF 2 ranked 8th on the average yearly benefit. You'll notice that the higher benefit levels are for specifically police and fire plans. The highest is the Houston firefighters, New Jersey Police and Fire, Nevada Police and Fire, and LEOFF are all up there. So, and the lower ones tend to be for the larger plans. You'll notice again that the Florida that I mentioned is just a tick under 20,000, whereas LEOFF 2 is in the upper 30s. For contribution rates, LEOFF 2 has the 11th highest contribution rates out of the 53 plans studied. Again, police and fire plans are shown to have higher rates to go along with their higher benefits and higher salaries than the normal retirement plans. For funded ratio, left 2 has the second highest funded ratio out of the 53 plans, just behind left 1. That's really all there to say about that. That's good. We also have the third highest salary out of the 53 plans. Again, the higher plans, the higher salaries tend to be for specifically police and fire plans, and the lower ones are for the larger retirement systems. For market assets, left 2 and 1 are similar. They're left 2 is has a 34th highest market assets. Again, some of the larger plans don't have their police and fire split out for their market assets. But one thing to make note of is that although we have the 34th most market assets, we're the 45th largest plan. So for our size, we have more market assets than similar plans. Another thing is that left 2 has the lowest retirement age out of the 53 plans that were studied. It's advantageous for the option to be available to retire early. Some of these other plans are up into the highest is 67. The average is about 60. For the final average salary period, we're tied for the third longest final average salary period, right in line. Longer FAS usually leads to less pension spiking issues, as we've seen recently. You'll see a couple of the plans up in 8 years, but usually 3 to 5 is the usual. Vesting period, it's right in line with the lower end of the vesting periods. 3 plans out of the 53 have a vesting period lower than 5 years, but 25 plans have a vesting period longer than 5 years, going all the way up to 12 years for certain plans. So a quick little summary of some results that are particularly strong for left 2. Our average annual benefit, which is what the average retiree gets in his pension, is 8th out of the 53 plans. The average salary for an active worker is 3rd out of the 53. Funded status, 2nd out of the 53. Lowest retirement age. Longer FAS period. And for comparative purposes, we took the first ranked plan income replacement from the WSIP study and compared it to left 2. And that was the New Mexico Public Employees Retirement Fund. So I'm going to compare their number first compared to the left 2 number. So the yearly benefit for New Mexico Retirement Fund employee was $23,279 compared to left 2's $34,390. Contribution rates were similar, 742 to 774 for left 2. Funded status, 78% for New Mexico, 119% for left 2. Average salary in New Mexico is $37,000. Average left salary at time of the study was $86,000, which we know has gone up now. Average retirement age for New Mexico is 67 versus 53 for left. FAS period, theirs was 3 years. Ours is 5 years. Vesting was both 5 years. So I hope that gives a little bit better understanding that sure, they might have had a higher income replacement, but there's a lot more factors you have to look into to see kind of what makes a plan successful. And with that, are there any other questions? And that's it.
Pat and then David.
In the average yearly benefit comparison, were any of the plans, did any of them cover medical? In that?
Not in that number, no. Not in that val for that specific number.
David?
I'm a numbers guy, and I just really appreciated these different stats. I thought they just really showed the nice benefits that Left 2 provides to our members. When you look at these different things of us, first out of 53, second out of 53, 8 out of 50, I mean, it really shows that we've been doing the right things for our members. So I like that.
Okay, are there any other questions, comments? Okay, I had one follow-up, Ryan. I mean, I know some of these jurisdictions here. I know them because I know some of the trustees or some of the members. These are probably updated since the recent changes. I mean, some of these were probably age 50 now. They're like age 58 or, you know, because I can't remember any of them being in the 60s for
some
police
of
fire plans.
Some of the data was collected in 2010, I think, from those vals. Either they didn't have an updated one, or for comparative purposes, they just kind of pulled the same year. But that's just the data that I found.
Okay.
Yeah.
I think the data is great. I'm just looking back, like at normal retirement age, that one page there, and I know I look around, and we've worked on these things for so long, you know, looked at all these numbers, and all of a sudden things have flipped dramatically, and I think most of these numbers probably reflect new plans that have just been implemented, not plans that are, you know, like ours, 30, 40 years old almost. And these are probably reflect like Florida, Ohio. They have all increased their retirement age and made a lot of modifications. So I just didn't know if this reflected some of the new changes that have happened as a result of the downturn in the market in 2008, 2009.
Yeah, some of the plans I did notice some of the plans changed their retirement age very quickly, and some of them were still planning to.
Yeah.
And so either it didn't get put in the val I looked at, or it's in this year's that just got released.
Okay. Mm-hmm.
Public safety members included in them usually had like a public safety tier within the plan, and that's what the comparison was is to the public safety tier. So we wouldn't be comparing you to general public employees, even though in a lot of the states the plan covers all members. In most states, public safety employees, police and fire, even if they're in the like Idaho PERS plan, for instance, they've got a separate tier of benefits within that plan.
Okay. Any other questions for Ryan? All right. Thanks, Ryan.
Yep.
Okay. Okay. We've got lunch ready to go. So what we propose to do here is to have you grab your lunch. Take a couple minutes. Don't wander away. Grab the lunch. Come right back. We hope to be done. A couple of the members have to leave a little bit earlier. So just grab it. Be back reconvening here for the administrative update at 12 o'clock if we can. Okay, so we'll be in recess for just the purpose of getting your lunch. Okay, we'll call the meeting back to order and begin with probably the second most riveting presentation we've had today.
All right. With that big build-up, I'll dive in. The first off, Select Committee on Pension Policy update in the interest of keeping things quick and brief. There was nothing left too specific on the agenda. One topic that the SCPP did discuss, other than the 457 plan that was mentioned earlier by Paul, there's been some federal changes with the Accounting Standards Board, and the Select Committee got an update on that, and it's something that many of you will be probably hearing more about, or your employers will be hearing more about, particularly next year as some of these changes begin to ramp up for implementation in 2015. But it's going to change the way that employers report pension liabilities on their books. Some of the bond lenders, for instance, began to notice, you're supposed to put your debts and your liabilities and your assets on the books, and a lot of pension plans, or a lot of pension plan sponsors, were underfunding their pension plan, and then that was a liability that wasn't as visible on the books. And so the accounting standards are changing to make some of that more visible in the future. The state actuary's office has been involved in in a project to try to figure out how to help employers report, for instance, what's their share of the PERS 1 unfunded liability. One of the things that may be interesting is, with respect to LEF 2, is what's their share of the positive LEF 2 unfunded liability. I recently had a presentation from someone who's saying that plans who are funded over 100%, that this may create a challenge for them, because if it shows up on the books as income, it's very likely, usually budget writers, if they see anything that they can identify as income, then the next thing is figure out a way to how to spend it. So not for December, but it's entirely possible that that'll be a briefing for the board again next year. DRS update, we have been working with the department on the implementation of the factors. They're going through some WACs right now, rule writing related to things like career change and some of the other issues related to that the board has an interest in. I only mention it for the purposes of saying that we meet monthly with them. The relationship right now with DRS is very cooperative, and they've been keeping us up to speed on new issues as they come up, which helps us then keep you up to speed on new issues. The one thing specific that I want to talk about, though, is Greg. Greg is still over at DRS on a developmental job assignment. They requested an extension on that, and Greg wanted the extension, and so I've agreed to that. And he'll be, the extension goes through the end of December. It may wrap up sooner than that, but that's the status there. Kind of leading into another issue, which is ombudsman. The position description, and before the position can be filled, we have to have it banded by the Office of Financial Management. We're expecting that kind of final approval step, if you will, administrative approval step shortly, certainly before the end of this month, and so then be able to move forward on that. I've had a number of people express interest, and I've already been moving forward in terms of talking to them, interviewing them, even though been clear that don't have the approval to hire anybody yet, but we're closing in there. Outreach activities. You all have received the emails with the copies of the materials, but just by brief way of mentioning, and in case give you the opportunity to have any questions, since the updated since the September meeting of the board, Law Cops has had their annual conference. They asked me to speak and answer questions there, and I did. The Seattle and King County law enforcement officers, Compass, recently had a meeting of their executive board and asked me to attend and answer questions, and I did. Kitsap firefighters, we're having a retirement. This was more a gathering of locals. They were having a retirement planning seminar. Asked me to come out and talk a little bit about LEF 2 and how LEF 2 benefits were coordinated or didn't coordinate with things like Social Security, and give them answer questions, attended that. Outside of Washington, the International Foundation on Employee Benefits Plans recently had their annual conference. Tim and I were asked to assist their trustee master program and provide some teaching to public sector trustees who are going through their master's program. That was just prior to the start of the annual conference, which we did. At the annual conference, both Tim and Tammy were asked to teach a class, do a presentation on moving into a paperless environment. and we're able to share some best practices and some of the lessons that we learned and that you learned in terms of making that transition with other plans around the country who are thinking about doing the same thing. So that was helpful. Correspondence. In your materials, you'll see the board received a letter from Gallagher Benefit Services. Yes.
Just thought, that you might want to recognize those of us that also participated in the International Foundation event and received certification.
For attending there? Yes. There were actually at the IFEBP conference and then again at NC PERS Public Safety, there were several board members, and I didn't know.
I think you just forgot. You forgot is all.
Well, historically, I haven't talked about that. I might talk about it a little bit here when I get to the budget update in particular. But yes, we've had a number. I want to encourage the board members to follow the messages that Tammy sends out about educational opportunities, to take advantage of those opportunities. It is no coincidence in my mind that the success, your participation, your willingness to participate, not only in the educational stuff that you get from these board meetings, from actuaries, CFAs, but your willingness to go to get training from outside parties as well is one of the reasons why I think as a board you've been successful. And issues like today's presentation, for instance, from Allison and the SIB, that could very well would have been the type of presentation that would have been overwhelming to trustees from other plans, even other plans here in the state of Washington. But because of the training that you have, the experience that you have, you were able to incorporate what was a lot of very important and valuable information in a fairly quick period of time. And so,
thank you, Steve.
The two last things, though. There is a quarterly budget update in your materials. Bottom line, we're about $58,000 under budget so far. Most of that has to do with the fact that the ombudsman position isn't filled yet. We are over budget in training expenses, but that's not uncommon for the first quarter or the second quarter of the biennium, because usually what happens is that's the time when staff and trustees are available. Usually during session, for instance, expenses drop down. So overall for the biennium, I'm not concerned about that right now, but if you were to look at those detailed numbers, that's one that at least at the current time jumps out in red. The final thing is the correspondence. The board received a letter and some promotional materials from Gallagher Benefit Services. They provide a life insurance program through NC PERS, which is one of the National Conference on Public Employee Retirement Systems. They asked for the opportunity to come to talk to the board to explain what their program is and how it could potentially be offered to LEOFF members and LEOFF retirees in the state of Washington. So that's I forwarded that material on to you, and it's in, it was a part of your packet. That concludes my administrative update, and I know I covered a lot of stuff very quickly, but I'd be happy to answer questions on any of those items. Paul?
I'd just like to thank you for sending
two representatives to the Washington State Fire Commissioners Annual
Thank you.
Educational Conference. Tammy and Paul, I think, were there, and they represented you people well, and they had put together a little presentation there that people actively engaged in, and they had a few questions and provided some answers, and I just wanted to thank Tammy and Paul for that, and look forward to having them come again. And by the way, thanks to you, maybe your signature, I won that bingo thing. Yeah. So, any inside pull or not, but anyway, I want to thank you for that. Appreciate it.
Thank you, Paul. And yes, I apologize for neglecting that. One other thing that I meant to mention as well in terms of Tim was recently elected to serve as a officer on the Pacific Northwest chapter, the board of the International Society of Certified Employee Benefit Specialists. So that was one other item that I had neglected to mention earlier. So again, thank you, Paul. Any other questions?
Any other reminders for Steve?
Yeah.
The
Pat.
correspondence you sent, Steve,
Yes.
regards to the life insurance policy, are you going to be making a presentation on that in the future, or what's this?
Well,
How are you dealing with that?
that would be up to you. If you would be interested in hearing a presentation on this, we could follow up with Gallagher and schedule that for a future board meeting.
Yeah, I'd like to see if you could make contact with them and see, it mentions here, it said, I'd be pleased to meet with the board and present the life plan and answer questions. If we could invite them to the December meeting, and then we can find out, working with you and with them, when they're available to make that presentation.
Will do.
So,
Oh, David?
yeah. So I just thought it was promotional material, and was it something that really the board wanted to talk about? Was that type of insurance? I haven't heard us talking about those type of benefits, and I know working in different organizations, we get that kind of promotional material, and we do offer certain things to our employees. I'd be surprised. I didn't realize that was on our agenda to kind of go through that kind of material to offer additional benefits like that. I mean, because I think but I haven't heard the board have that conversation.
Now, historically, this isn't something that the board has received, these kind of, materials or offers in the past. I was trying to remember if, for instance, in the last 6 years, for instance, I know I don't remember anything. I'm trying to, I don't, there may have been something back in their early days. I did ask, do they do this for other states? Do they do it for other, so it may be something that you would be interested in. It doesn't tie into the pension plan at all. It's more targeted toward the membership, and that it's similar to the one tie-in is that the number one expense, if you will, is for retirees is health insurance. Now, this is
Right.
life insurance, so this is something different. But that's the one piece that when they talked about several of their other statewide clients and their other statewide police and fire plans that they presented to, I don't know. I don't know enough about the project or their product to answer any of those questions on their behalf. But if you want to hear from them, we can reach out to them and try to schedule that.
So I was just wondering, Pat or Kelly, if you
Yeah,
had those questions or concerns, or
I don't have those concerns necessarily, and when we looked at the other plans, and I talked to other folks, I mentioned Arkansas here, Illinois, and as an adjunct to what we do here, making it available, we just thought it would be interesting here to hear what they have to say. There may be better products, different products out there, but this is the one that works through NCPERS, which we have a relationship with and has a good reputation for education and working with retirement system. So that was the only reason why this group versus anybody else that might cold call us. This wasn't a cold call. This was when Steve and I were at the annual conference. I believe they approached us and asked if we could. And the past president of NC PERS is a Tacoma firefighter and had been serving on the State Investment Board. So he was kind of the conduit there that brought this together. Does that conclude your update, Steve?
Yes, although I'd be, again, if there are any questions about any of those. The next item up on the agenda is a follow-up on the final average salary presentation that you had earlier this interim. With that, I'll turn it over to Ryan.
Thanks again. For the record, my name's Ryan Frost, research analyst for the board, and this is the second follow-up on the final average salary protection. Members' retirement benefits will be reduced if furloughs after July 1st of this year occurred during their FAS period. Furloughs were methods for handling a short-term economic problem and have been utilized during the economic downturn. If a member's salary is reduced during their FAS period, then their benefit for life would be negatively impacted because FAS is part of their benefit calculation. FAS protections were legislatively protected for the 09, 11, 11 to 13 bienniums, but again, those protections ended on July 1st. So there was a series of legislative actions between 2009 and 13 that led to this issue. In 09, the legislature recognized that this could be an issue for employees and passed protection, but the protection only covered PERS employees. So left to would not be granted the same protections as PERS would. So in 2010, when the furloughs came, state agencies were directed to achieve a $69 million reduction in employee compensation costs. So they furloughed their employees, and they ended up having to pass a bill that would basically cover left to and other state employees as well. So that bill was House Bill 2070, and it created protections for all state and local government employees. The bill introduced in the 2013 session did not pass, so that leaves us basically with two options. You can take no action. The board would take no further action. Employees who are furloughed during their FAS period after July 1st, 2013 would continue to face reductions in their retirement. Option two is to introduce legislation that extends those protections from House Bill 2070 into the 13 to 15 biennium. And with that, I'm happy to answer any questions.
Okay, are there any questions? Mark?
Is there a cost associated with this?
No, not that I know of. Steve might know that better.
The actuary's office has been working with us to try to come up with a fiscal note. Depending on the number of members, essentially it gives them a higher salary than what they actually were getting paid and what they were making contributions on. So if there are a number of members who would receive this benefit, it would have an actuarial cost. In the past, that's been hard for them to quantify because of uncertainty about the numbers of members who'd be impacted and how much they'd be impacted. We've been surveying. Some of it's been like through the State Council of Firefighters, through WACOPS, through Compass, Fraternal Order of Police, trying to figure out how many local government public safety employees are out there that have been impacted by furloughs or salary cuts since June 30th, 2013, and we haven't been able to find any. So there are a few areas where it looks like there may be some salary concessions applying to general government, but it looks like for the state, all of those concessions ended June 30th of 2013. So the state left 2 members, the small group, are not impacted by this, and we haven't been able to find any local government employees yet that have been impacted as either. So, in all likelihood, right now, it would be that there is no cost, but because it doesn't appear to be any benefit either. If there were members who were impacted by this or that this applied to, then there would be some cost associated with that. If the board moved forward on it now with a fiscal note, it's likely that the fiscal note would just say there's a cost, but it's indeterminate because there's no data on who it would apply to.
And just as a point of information here, we haven't been able to find that anybody at the Washington State Council, we've talked about this at each one of our board meetings, there haven't been any reports of anyone suffering this type of loss as a result. So in order to take up a bill to try to solve a problem that doesn't exist, seems like a lot of energy. So at this point, I don't know that we need to take any action, and in the event that something occurred, we would have the opportunity to act quickly if we needed to. Patrick?
So nobody has affected since July of 2013. Just to let you know, we have 4 members that are directly impacted and covered by 2070 that are retiring this year, and probably 3 to 6 that will be benefited by the House bill next spring. So it is impacting people. I mean, having the bill is a benefit. One of the issues has been the employer group having enough knowledge to be able to process the that furlough. Ours was a furlough related to wage. They reduced our wage after they gave it to us. So for 11 months, they took it away. In lieu of losing people, the whole body took a pay decrease, the cost of living decrease. But the employer group is having trouble. The issue with DRS says, what was their pay for their final average salary? The employer group, it was a lack of communication and just lack of knowledge on that bill. So we've been having to educate our employer on that. And it's when people are going through retirement, they're having to process a lot of information, not knowing a lot about that bill individually, each individual. It's been difficult. We've had some people that have slipped through and having to play catch up. So it's just kind of a warning for other people. If you are affected by furloughs and it may be a benefit they may be going after when they retire, the information is critical.
That's a good point, Pat, and we can make a note to include a reminder on that in the newsletters for a while as retirees, because this will probably be affecting retirees for the next 5 years, and there is no way to report through the system to DRS that an employer took a furlough or a salary cut. So the way it's handled now is at the time an individual retires, it's sort of, they need to make the DRS people aware of it, and the DRS people are trying to remember to ask them about it. But if they don't remember to ask, and some of the left folks may not even remember or be aware that, oh yeah, there was a bill that was supposed to help me through that. They may not think to bring it up as well. So a reminder on that to kind of help fewer people slip through the cracks, that's a helpful suggestion.
Yeah.
Thank you, Mr. Chair. With the attempt to not let this just go into limbo, but maybe hold it in place, would it be appropriate to make a motion to table this topic pending identification of anybody that would be affected by the proposed legislation.
That works.
So moved.
Okay, motion table, is there a second? Moved and seconded, not debatable. All those in favor of the motion to table, please signify by, do we have to vote on it? Okay, so the motion is to table,
And essentially,
which
what I
is
hear-
almost
option one is you're not going to take any further action
at this time.
at this time. Yeah.
One more.
It's locked up.
Okay, you probably timed out. So you're voting in the affirmative?
Affirm.
Okay. Motion carries. All right, item number 9.
This is another follow-up to a topic that you've heard about twice this interim, career change. By way of introduction, also I wanted to let the board know I was recently contacted by the reporter who wrote the article about the career change topic, but also specifically about DuPont, and he was following up on both issues in terms of left to retirees being hired as independent contractors, which was the original DuPont thing, and then also left to retirees being hired as part-time chiefs, which was ties into the career change issue. With that, I'll turn it over to Paul. I bring that up only by way of saying that I'm sure we'll have additional reporting on this prior to the start of legislative session, and as soon if we see anything in print, we'll forward it on to you. Paul?
Thank you, Mr. Chairman, members of the committee. Again, for the record, my name is Paul Neal, Senior Legal Counsel. Talking about the career change issue, we have talked about this in August and September, and you'd asked for some additional follow-up information to see if you wanted to get to a final on this. Again, just kind of refresh your memory about what this is about is abuse of the original career change legislation can undermine public trust, and at the hearing, the board asked for further information on either closing what I'm calling the DuPont loophole, which I'll explain as we get into this, or option 2 is to allow post-retirement employment in a left position, possibly with some limitations. So again, just to, as Steve was mentioning, the DuPont situation where what was formerly a full-time police chief position was converted to a part-time position in order to facilitate hiring a Left Plan 2 retiree to come in and fill the position and continue to draw his pension. And that's an unintended consequence of the career change legislation that this board originally proposed, which was to, as the name states, was to allow someone to retire from a law enforcement or firefighter career and then go into some other public career that was a change. One thing that I want to remind the board about with this slide is we did in September as well. We got some information from DRS about the usage of that benefit since 2005. There's 263 people, and their average salary is $28,000. So people aren't getting rich off this. The majority of the employers that people are working for are not left employers. So by definition, they're not going to be in left jobs. If you're working for a school district or a state agency or a political subdivision other than a fire district, and even the big green wedge of the cities and counties are left employers, but from looking at the data, it doesn't appear that any or very few of the people that are working for a city or a county are working in left-type positions. I think it would probably be an exaggeration to describe that number as a handful. It's probably more like 1 or 2. So most people are not making bank on this, and most people are not working as, most people truly are changing careers. So to getting back to the options that the board had asked for further information on is one is you could just clarify that law enforcement officer or firefighter jobs that have those duties do not qualify for the career change law, even if they are not technically full-time or fully compensated. That would deal with the issue of this redesignation, like what happened in DuPont, to take what really is a left position and then call it part-time to get around that. One issue that was brought to my attention actually at the fire commissioners conference is that there are some bona fide part-time jobs out there. There was, in that particular case, there was a gentleman who was a part-time assistant chief out of fire district and had been reported in LEF, and then DRS found that he wasn't full-time, and so said he couldn't be in LEF because he's not full-time, and he wasn't very happy about that, nor was his employer. But it kind of brought up the issue that there are actually some bona fide part-time jobs out there that, while they may be associated with a fire district or police station, they're not, they're properly excluded from LEF. So you kind of got balancing factors. One way you could balance them is, and again, the issue is kind of distinguishing between positions that are being manipulated in order to achieve a certain outcome versus positions that are legitimately not in LEF. And basically the question is this position being changed in order to accommodate the person they want to put into it? A possible way to balance those factors could be to require that suspension if the position duties would qualify for LEF if full-time, fully compensated, but allow an exclusion if the job falls below some threshold requirement, such as 867 hours per year, which is what the PERS and TERS standard is, or 25 hours a week, or maybe some other standard. Option, which is the second one we're considering, but it's retaining the former numbering of option 3, is to go ahead and allow reemployment in a LEF position without suspension of pension in some limited circumstances. And a couple of the board members talked about this issue a little bit at the September meeting, I believe it was. And one of the issues was, well, it's kind of the nub of the problem or the issue with retire-rehire generally, which is, on the one hand, you've got retirees with a good set of skills, they've earned their pension. Why shouldn't employers be able to take advantage of that considerable training and skill set? And then you've got the other issue, which is, as Glenn Olson said, the public just hates it. So you kind of got those to balance. One issue that was talking about is that was mentioned by one of the board members that if you've got smaller jurisdictions that are paying lower salaries, they can't really compete for the people at the upper end of the scale who are, say, working for King County or something like that, and that allowing them possibly to allowing exemption for those folks to be able to hire someone who's retired from a larger, presumably better paid district, could be a legitimate way to allow them some access to some talent they wouldn't otherwise be able to compete for. So what we did is looked at the correlation between population and salary, and got some data from the Association of Washington Cities. This is all cities, so I don't have fire district or county information here, and looked at what the salaries were. I had to kind of massage the numbers a little bit, so I kind of give full disclosure about that. What I got from AWC was a range, a top and a bottom range, so I just kind of split that in half, and that was the position. And then I took those numbers, and for a particular population cohort, took all of them in that cohort and then averaged those. So this is, Paul Neal's averaging here that we have. And what you can see is that there is a correlation between population and salary for chiefs. It's not a straight line, however. It kind of goes up and down. So it's not a perfect correlation. I've also got one here for police chief. There's quite a bit more data for police chiefs because smaller cities and towns have police chiefs. A lot of them don't have fire chiefs because they're part of a fire district. And here again, you've got that relationship between population and salary. But again, it does kind of, it's not a straight line relationship. The correlation can be weak. I wanted to pull out a couple of data points just to kind of make this point. It was that if you look at, say, DuPont, for instance, and they've got a population, and then College Place, which is in Walla Walla County, almost identical population, $1,000 a month difference in the average chief's salary. So population isn't necessarily a good predictor, and that's even more pronounced. This really jumped out at me as I was looking at the data, these four here below, where you've got essentially a similar population, about 11,000. You've got a $3,600 range in the chief's salary, and again, it looks like a better predictor of that differential isn't so much population as it is whether it's an urban or a rural location. So if you wanted to do some sort of a population-based limitation, the attractive part about that is it's a simple, easily verifiable number. The thing that doesn't work so well is that it's not that robust of a connection. And also, if you really wanted to make sure that your policy, which is to allow basically chiefs or people who retire from larger, more highly compensated jurisdictions to go to work for more smaller, presumably less highly compensated, you would want to have like a population limitation, which is, making sure that people aren't just going from a small place to a small place. You'd have to be tracking, well, you wouldn't have to, but you might want to track pre-retirement employment to make sure that this really is, that they're going to a different employer. They're not just retiring and then taking a promotion, something like that. And also you might want to look at duty limitations to make sure it's only people who are at chief level. So, kind of the recurrent theme is that if you really wanted to pursue this policy, it would create some administration that could be fairly complex, might generate a fiscal note, and the more complicated you make something, the more subject it is to gaming. Although it is also true that LEOFF does have a statute that makes it a felony to misreport to DRS on pension reporting information. I don't know that that's ever been actually enforced or not or used, but that is out there. The other option, that I'm calling 3B, is just to say if you're a left to retiree and you go into left position, you have the same ability in a career change you'd have now if you went into a PERS position, which is basically if you're retired, you go back into a left position, you could either choose to go back into left or you could choose not to and keep drawing your pension. That would change the original policy because it's no longer about career change. The advantage to that is that it's more transparent. Right now you can sort of do that, as DuPont has shown us, but you kind of got to game the system a little bit. You have to kind of get in through the back door. I would describe it as a large potential for unfavorable public and legislative reaction. In 2011, the legislature passed 1981, House Bill 1981, which rolled back retire, rehire possibilities or abilities to do that in PERS and TERS. So the legislature is moving in the opposite direction right now. So the next steps would be to direct staff to draft legislation on one of the three options or decide not to take action at this time. I'm happy to answer any questions.
Are there any questions for Paul? David?
Because I have to ask a question for every presentation, I thought I'd jump in now.
Okay.
No, on this one, I really appreciate the presentation, and it is an issue in the public, and I think there is something that we need to fix. I'm getting concerned that as you went through some of those options, that as there's so many what-ifs and could-bes, I think we just find ourselves back right into a question about this. It's unfortunate that this issue came up and the person really was, it's more in left 1, happened to be a left 2 covered position as I understand it. I think getting something about the limiting the hours would be fine, but as you start having worked in small cities and larger organizations, that's just smaller organizations pay less. And people who work in those organizations know that, and there's other benefits that they get. I just don't think we want to get into that, doing it by population or things like that. There's just too many other factors, east, west of the state, urban, suburban, all those different factors. I don't see us getting into that part. So I do think we need to close that loophole. I would suggest going something more what the state has already done, but following that about hours worked maybe is an easier way to do that, if that's a way to move forward.
You wouldn't advocate a daytime population or anything like that, would you? Or?
Well, there you go. Yeah.
Coming from Tukwila,
Yeah.
Comment.
Go ahead, Jack.
I guess for me, I support the idea because I don't understand why we would bring people in from out of state to fill these positions out here when we have people right here in this state that are very well qualified. It seemed to me like a way to to kind of set this thing up. If you do leave your employment and you go to another jurisdiction, you may be a captain when you leave and a chief when you get there. If you're not eligible to participate in another a state retirement program, it kind of takes all of the fire out of everything. If the local entity wants to pay you additional money for a 457 or whatever, the expense is on them and not on the state. But I don't see that eliminating those guys or pulling those guys that want to do that from the system and the communities, bringing people in from out of state. I've worked for guys from out of state, and trust me, it's not always a real pleasant opportunity because they don't understand how we do things here, and they don't want to change. They want to train to bring something from another state or another organization that has no clue. They come from a right to work state into one of these, and it's like, well, I'm the chief and I can do what I want. And then you end up in a labor law seminar on a regular basis and putting these guys through a process to get them to understand what you're trying to accomplish. So to me, that seemed like that would be a viable option as well.
Jeff?
Thank you, Mr. Chair. A couple different thoughts. I'm currently in a situation, although the situation I'm in is not politically adverse, so to speak. Elected to the legislature, I'm eligible for the PERS 2 retirement system, and yet I'm receiving a left annuity at this time. I had the option to decline participation in the PERS system and maintain my contribution, maintain my annuity coming from the left system. And in that scenario, there doesn't seem to be a lot of political pushback. I think Glenn was right to do something like this. Just open it up and say that you can to create almost the equivalent of a retiree hire, and allow employers the benefit of hiring somebody without having to make retirement contributions, and that person to get a retirement distribution annuity at the same time they're receiving the same salary they had for the position they held moments before in a different capacity, just appears wrong. Now there's the dynamic between the two issues. It exists in other capacities, but it's not politically incorrect. I've got to follow with what Jack's saying on this, and that we have a lot of people in the smaller jurisdictions that are sergeants or even patrol officers from other smaller departments or medium-sized departments that go to work because there really is no financial consequence for doing so. At the same time, we have a situation where we have people have tremendous amounts of money, time, training invested in them, FBI Academy graduates, sergeants, lieutenants, captains from the largest departments in the state that after a number of years would love to have access to something that is a little bit less dynamic of an assignment and would make the kind of chief that the smaller departments wouldn't be able to finance, structure, train, or send through any of the higher level national academies that would be willing to take this position. I did run into this with Medical Lake before they contracted out to the Spokane County Sheriff's Department here, and some Spokane City lieutenants were interested in that position, unable to do so because removing the pension distribution would be so far outweighed by 1/3 the salary they'd be receiving in a smaller department that it just wasn't financially viable. I guess what I'd suggest is maybe having Paul follow up a little bit more and attempt to do a little bit more of a, under 3A, option 3A, come back and give us a little bit more of a tightened up proposal to try and identify some of the potential abuses out there that would be of political consequence to proposed legislation such as this, and to try and circumvent some of the things that would be at issue. Obviously, 3B is something that we all realize the viability of something like that isn't. At the same time, the utility of this idea is worthy of consideration. We just need to figure out how to package it, how to propose it and how to message it. So that being said, is it appropriate to move additional follow-up rather than make a decision moving forward at this time?
Yes.
So moved.
Okay, moved and seconded. The request is specific to option 3A, is that correct?
Yes.
Yeah. Discussion.
Mr.
Bob?
Chair, are we just going to have a conversation about chiefs and administrators, or are we actually going to broaden the focus and talk about regular line guys? Because as I said before, in our agency, we have 46 individuals who are capable of retiring at this point. If the agency chose to allow them to retire and then the next day rehire those folks, there has to be a point. At some point, there has to be a consequence to the retirement system. So, whereas we're talking about one chief here, inevitably, we're talking about many more. So, I think it's important if we're going to do that analysis to actually try to identify that inflection point when there's a detriment to the retirement system. Because as those people come back to occupy a position, a left position, they're drawing a retirement, but at the same time, there's nobody there to replace the contributions.
Okay.
And I just want to state for this board is that, being an employer who has had to face these issues of bringing in chiefs, there is a broader discussion I would like to have, is that we have talented folks in our line and other places that are also want these positions. And it's unfortunate as an employer that we often look for people who have already held that same title. And so I don't want us to focus so much that you need to have the experience from being in a large city to come serve a small city. Is that I've had great sergeants and lieutenants who've come and been police chiefs in small jurisdictions, and they're wonderful. So I don't want to deny opportunities to other left two members to advance their careers in other situations. So, I want you. There's a lot more implications than just saying someone who has been 30 years and they're retired and now they're looking for something else to do. I hire lots of consultants, and they help us in doing those, and we use those experiences. They don't need to be in that job full time, and we've been able to manage that. So there's a lot more complicated this than just the one story of a chief that wants to go continue working. So,
Can I get an application? Wally, I think to address maybe part of what you brought up there, I get that. Maybe as part of the process that you can't work for the same agency you're retiring from, and you don't fulfill those positions like you're talking about. If you want to retire and go somewhere else, retire and go somewhere else. If you're going to stay where you're at, stay where you're at. You can't. I don't agree with retire or rehire at the same agency. I don't think that makes any sense at all. That's obviously trying to get your feet in the trough. My thought.
Okay, so I take it Jeff's motion was specific to option 3A, but I hear a lot of things about option 1 being discussed here. So without knowing whether or not, Steve, is that an option to address option 1 if someone asked for that and 3A, or is that like asking staff to work on?
No, we could bring you back both in December, and you can make you'll be voting in December is what you want to do, if anything, about either of those options. You don't have to make choose amongst the options today.
Okay. Jeff, did you have a?
Oh, just, Mr. Chair, just for, as a matter of protocol, a friendly amendment accepted.
Mm-hmm. Yep.
Okay.
Also, one last point. All the issues everybody's bringing up are exactly the reason I made the proposal. We need to tighten it up. There's so many what-ifs out there in applications that are at issue, will be at issue, that if this is to have any viability at all, Paul's going to have to, at a minimum, contact people individually or have them contact him and get all these in place so that he can craft something that might work.
Okay. I think that we just create some sort of position for Steve Nelson to be like the career change czar, and he just makes those decisions, you know, when they work and when they don't.
I don't think you'd want that. I tend to be more along the lines of the public, I guess, in this sense, and so that's good reason why I don't get a vote on any of these issues that affect your guys' plan.
Good to know, Steve. Thank you. Okay, so the motion has been amended to ask staff to bring option 1 and option 3A back to us for further consideration. Further discussion. Okay, seeing and hearing none, all in favor of that motion, please vote on your pad.
Well, Mr. Chair, as I'm still locked up, I'll give you an aye.
Okay, must be a law enforcement thing. Oh, sorry, Wally. Jack, are you an aye?
I am. Get kicked off.
Okay, motion carries.
If I could ask a clarifying question, maybe I should have asked this before you voted. On option 1, there's the piece about just saying any job that would be a left job, but for being full-time, fully compensated, also is covered by career change. Did the board also want to look at some kind of exclusion to that?
That's what we'll bring that back in December.
Okay.
And just one clarifying, it would be helpful to know what has already happened at the state level in the PERS system. I'd like to have a table just to make sure, are we in line with what's going on in the other systems, or are we out of sync? And just want to make sure because that's, if we're going to do some legislation, that's where we'll have to go. So, thanks.
Thank you, Paul.
Thank you.
All right, we have one final action item on today's agenda, and that is the adoption of the 2014 meeting calendar that was provided to you at the October meeting.
All right, take a look on your iPads. And those are the dates that we are scheduled. Motion has been made to adopt. Is there a second? All right, it's been moved and seconded to adopt the yearly calendar for 2014. Proposed meeting dates. Any questions or comments? Okay, the motion's been made, seconded, and the vote is before you. Okay, take a look here. We have agenda items for future meetings. Is our last item of business.
You currently have 4 items based on the today's meeting and prior meetings. You've got 4 items now for action.
What are those?
There's the adoption of actuarial factors, the follow-up from today. There are 3 legislative proposals. One is a technical correction that you previously moved to final earlier in the interim. And then today, career change and the promoting savings for individual savings for retirement. You moved different versions of those issues to final for December. In addition to those sort of 4 action items, you also asked that we pursue seeing if we can get the NCPERS life insurance program presentation scheduled for December as well. We'll try to do that and see if we can schedule that with them. If we can't, I'll let you know in December and try to follow up with them in the next interim.
Okay.
Those are the items that are currently on the agenda.
Wally?
Mr. Chair, if we could, since I haven't been on the board very long, possibly schedule a presentation about alternate revenue.
Okay,
Yes.
Steve, could we get a presentation on, update on that?
Yeah, there was a lot of questions about that, both at Walkops and at Compass, where that stands and leading into session. And so, yes, we'll have a briefing on that.
When was the last time we did a briefing on that?
I don't know that we've done other than a quick updates in the admin meeting, I don't know that we've done anything on it since the bill passed in 5 years ago. Other than occasional briefings about whether or not we were going to hit the trigger or those kind of things, I don't think we've had any kind of policy briefing on it in the last 5 years.
Okay. As I look around, Wally and Paul, and then before David left, were the only ones that hadn't been here when we passed that bill, or when the bill was passed with our support.
And I know that actually,
6? Oh, and the 2 legislators are new as well.
and actually on the legislative side, that was one of the things that came up in the session when they were talking about it on the budget is I didn't realize how much legislative turnover there had been since that bill passed, and that many of the legislators who were hearing about the issue in terms of the budget briefing weren't in the legislature and hadn't voted for the bill. And so it was so that's a timely point. And yeah, we'll get that scheduled for December.
It's not the appropriate turnover. Okay. Any other items? Thank you, Wally, for that reminder. Okay. Any other information or action to come before the board before we adjourn?
Wilson could tell me when the planning meeting is by calendar.
We won't have any strategic planning next year. Let's see if I can sneak it by you again.
No updates, revisions?
Well, we'll talk about the interim agenda. In all seriousness, we'll talk about the interim agenda at the beginning, and there may be some parts about the plan that the board as a whole would want to review, even if some individual members may not want to review them.
Okay. All right, any other items to come before the board? All right, seeing and hearing none, we will be adjourned until the December, what's the date of the next meeting? December 18th meeting, is that correct? Okay, we will be adjourned.